Hello everyone, welcome back to our channel Vedangas. This is Amit, accompanied with my co-partner Sumit. So guys, if you like your video, please subscribe to our channel and hit the bell icon for regular updates. Now let's go to the video. Hi everyone, this is the second video of the valuation of goodwill chapter. And in the previous video we have seen the concept of goodwill and we have seen lot of example to understand this concept easily, right? So in this video what we are going to do is, in this video we are going to solve this problem by average profit method or average profit method. Okay, we are going to calculate the goodwill with the average profit method. Okay, so before solving the problem, let us understand the formulas of average profit method and how this method works. Fine. So let's understand the average profit method. There would be simple average method and weighted average method. Weighted average method we will discuss later, but now we will discuss about the simple average method in average profit method. Okay, so now let's understand the average profit method through this example. So let's say this is you and you have to purchase this existing business from Sumit. Sumit is the owner of the business. Okay, and this business is very profitable business which has making lot of profits in the past. In 2016 profit, in 2017 profit, in 2018 profit, and now in 2019 also profit. Yes, so there is a good chance that if you purchase this business now this year, then in coming year also, in future also, this business may earn lot of profit as it is same in the past, right? So can you say that you will earn indefinite profit in future also, that is same in the past? Can you say? No, you cannot say that. Why? Because the market is so dynamic. Anything can happen in the business environment. Anything can happen, right? There can be a new competition, there can be changes in government policies, and anything can happen in business environment. Your business may demolish due to some government purchase, changes in policies, etc. Anything can happen. So that is why you cannot assume that you will be making profit in future also as the business earned in past, right? Yes, you can say that your business will be making profit for, let's say, for 3 or 4 or 5 years, but not more than 5 years. So let's take an example of Snapdeal. For example, if you go back 5 years, the Snapdeal was doing well in the e-commerce market, right? The Snapdeal was doing well in the e-commerce market, but now it is not doing well. Now Amazon is doing very well, Flipkart is doing very well in the e-commerce market, but Snapdeal is going back while we are comparing to last 5 years. Okay, right? So that is why in anything can happen in the business environment, so that you can assume your business may earn only 3 to 4 or 5 years profit in future as it is in past, right? Clear? Now the big question is, will Sumit sell his existing profitable business to you? Will he sell? No, of course not. He will not sell his business, his profitable business to you. Why? Why? Because he can earn these profits in the future. But if he sell this business to you, then he may missing out these all future profits which he may going to earn in the future, right? Because it is very profitable business in the past, so there are a huge chance that this business will earn in future too, right? And he has put so much effort into this business. He had built its reputation, he had made its recognition in the market, he made a good customer base for this business, and many more. He had made so many efforts for this business. So you are getting a ready-made business if you purchase this business in this year, right? Then you will getting a profitable business, ready-made business in this year. So if you go on yourself by creating a new business now, then it will take 4 to 5 years to build the same business, right? So that is why you to purchase this business and Sumit to sell this business, you have to pay him something extra for this business. For the future profits, you have to pay some extra to Sumit, right? If the fair value of net asset of this business is 10 lakhs rupees, then you have to pay 30 or 40 lakhs rupees for this business, right? You have to pay premium, you have to pay extra for this business. Okay, why extra? Because Sumit has put so many efforts on this business. He built its reputation, he made this business recognition in the market, he made a good customer base for this business, and many more. He made a lot of efforts into the business. So thus you have to compensate Sumit for this business, for the future profit, which if he wouldn't have been sold this business, then he may earn lot of profit. So for that you have to pay the extra amount for this business. So in this average profit method, what we have to do is we calculate the future profit. We calculate the future profit. That would be average future maintainable profit. It is called FMP, future maintainable profit. So now you will say, how we are going to calculate the future profit? How can we know this business can earn what in 2020, what in 2021 and 2022, right? See, we can calculate the future profit in the base of past profit, right? In the base of past profit, we will calculate the future profit. So we will see that now in practically by solving the problems. What we are going to do is we are making some adjustments. What we are making? We are making some adjustments to find the future profit in the basis of past, right? We are going to adjust the past profit for the future profit, right? Future profit will be 2 to 3 or 5 years, right? So keep that in your mind, okay? So as I said, you have to compensate Sumit for this future profit, right? So that is the goodwill. You have to make some extra payment to Sumit for the future profit. So that is goodwill. Clear? So what I said, we have to adjust past profit for the future profit. What adjustment I will say? So we have to do some adjustment, and then you have to calculate the average profit for future. Okay, how do you calculate the average? In the question you have given 4-year profits, then you take the 4-year profits. Okay, let's see, 1 lakh, 1 lakh, 1 lakh, that is 4 lakh, and these 4 lakh will be divided by number of years. The number of year is 4 years, that is 4 year. So 4 lakh is divided by 4 is 1 lakh is the average profit. So for example, right, not in the problem, okay. So for example, the 1 lakh, 1 lakh, 1 lakh is 4 lakh divided by 4 is 1 lakh, okay. And then you will calculate the goodwill. Easily you can calculate the goodwill by multiplying the average profit into number of years purchased, okay. Multiplying the average profit into number of years of purchase. So what is the number of years of purchase? It is the future profit which the business is going to earn in future. So for how many years the business may earn profit, so that years should be taken and multiplied with the average profit. So right, so that when we multiply for that, here our average profit is 1 lakh. So 1 lakh into number of year of purchase, that is 2020, 2021 and 2022. 3 years of average, 3 years of purchased, that is 1 lakh into 3, that is 3 lakhs is the goodwill. For example, okay. So this is the simple concept, the simple method of average profit method, right? So on the basis of past profit, you calculate the future profit, and then you compensate the Sumit for the future profit. You pay some extra for the future profit, okay. So here you are making the payment in now only, in 2019 only. So you have to make some adjustments, just the past profit for the future, because many things can happen in the future. So that is why we have to make some adjustment for past profit to find out the future profit. So now we will see the adjustment now in the formulas, okay. So now here are the formulas of average profit method. See how we are going to calculate the goodwill with the average profit method. See, first you have to calculate the average profit, okay. It is called future maintainable profit. So how much profit the business will earn in future, so that we have to calculate here. This is the formula. So to do that, to calculate average profit or future maintainable profit, we have to take past profit, right? We have to take all the past profit and you have to add all the past year profits and it should be divided by the number of years. Fine, so we will get average profit. Yes, and then to calculate goodwill, what we have to do? We have to multiply average profit or future maintainable profit, calculate goodwill, whatever answer we get from this, the average profit, we have, it is multiplied with the number of years of purchased. Number of years of purchase means for how many years the business is going to earn profit in the future, right? So we have to take that all year and we have to multiply that with the average profit, and then we will get the goodwill. Simple, right? So this is the formula of average profit method. So now we will see the adjustment. So let's see the adjustments. Tax adjustment, they will not give in the exams, so don't worry about it. Okay, they will only give mostly abnormal loss, abnormal income, future income and future expenses. That's it. Okay, fine. So what you have to do is you have to add the abnormal loss. You have to add the abnormal losses which is happened in the past years. Okay, for example, let's try to understand that. For example, in 2015 there was a loss by fire. Let's see, 8 lakh profit has happened in 2015, but let's see 2 lakhs of loss had happened because of fire. So now what you have to do, you have to add that loss by fire 2 lakh, and you have to correct the profit of 2015 from 8 lakh to 10 lakh. Okay, but why did I add the loss? Don't we subtract the loss? See, that is because that loss is an abnormal loss. It will not happen in the future. Can you see that fire will happen in every year and in the future also? No. It will not happen in the future. So that is why it's an abnormal loss, and we have to add the abnormal loss to correct the profit, to correct the future profit. We are adjusting the profit for future. In future, that loss will not be happen, so we have to add the abnormal loss here. Okay, right? Clear? And then we have got an abnormal income. Abnormal income is a non-trading income. Any income which we will not get in future. Okay, so that is abnormal income. Let's try to understand this. If you purchase this business now in 2019, let's say Sumit has made a lottery in 2019 and lottery house of 1 lakh, and in 2019 Sumit has earned a profit of 12 lakhs. Then you can't say that in future also you will earn a lottery as in 2019. Of course not. You cannot say that. You will made a lottery in future also and you will earn a profit for the lottery, right? So that is why that's an abnormal income. It's not related with business. Okay, you are purchasing his business. The lottery is not related with business. So that is why it is an abnormal income, and you have to subtract the abnormal income. Okay, simple. So the abnormal loss will be subtracted, and then we have future income and future expenses. So you have understood about abnormal loss and abnormal income, right? We are going to do opposite of this. Okay, opposite. So loss will be added and income will be subtracted, and then you have got future income and future expenses. The future income and future expenses means the income and expenses which will be happening in the future. So as you are adjusting this profit for the future, right? So you have to add the future income. Okay, because it is going to increase the income of the business in the future. So this is what you have to do, and after finding this all, after doing this all, you will get future maintainable profit, the profit which the business will earn in future. Okay, then we will take the average of this profit. Simple. First we will do these adjustments, and then you will going to add this for average profit, and finally you will get goodwill. Fine. So this is the adjustment you have to do. So now let's solve the problem by doing some adjustments. So here is the question. So let's solve this problem. See, X company limited purchased the business of Y on 30/6/2019, and the profit earned by Y in the preceding 3 years. Preceding 3 years means like before these 3 years, the past 3 years. Okay, so they have given the profits of past 3 years, preceding 3 years ending 31st December as follow. 2016 profit is given 80,000, 2017 profit is given 90,000, and 2018 is 70,000. Okay, so these are 3 years past profit. Okay, and then they have said on scrutiny of the account the following info was revealed, and then they have given some adjustment. You can see A, B, C, and D. These are the adjustments. And then they have said the goodwill of the business is estimated at 2 years. Purchase of average profit is estimated at past 3 years. So what we are going to do? We are going to calculate these past 3 years to get the average profit and goodwill. Okay, we are going to multiply with the average profit. We are going to multiply with the 2 years to find the goodwill, right? Fine. So now let's solve this problem. So first we have to adjust the past profit. So in this question we have 3 past profit, that is 2016 profit, 2017 profit, and 2018 profit. Yes, so we have to take that here. Okay, fine. Profit 80,000, 90,000, and 70,000. And then let's see the first adjustment. And the first adjustment is the profit of a year 2017, right? 2017, the profit of a year 2017, including a non-recurring income of 3,000. Okay. So now, what is non-recurring income? Non-recurring income is this 3,000 income is generated in 2017 is not be generated in the future. That it is non-recurring expenses 3,000 rupees. It is not recurring in the future. It will not generated in the future. So this is abnormal income. What? Abnormal income. So abnormal income should be subtracted. This income should be subtracted. So we have to subtract 3,000 from 2017 years. Okay. And then the second adjustment you have is profit of year 2018 was reduced by 9,000 rupees on account of extraordinary loss due to fire. Okay. So now here what they given? Here they given that in the year 2018 there was a loss due to fire of rupees 9,000. Okay. And due to this loss the profit was reduced. The profit was reduced. In the year of 2018, there was a loss. The profit was reduced of 9,000 rupees. Okay. So these 9,000 rupees, the loss due to fire, it is non-recurring. It will not reoccur in the future. Okay. It is non-recurring in nature. The fire does not occur every year. Okay. It has happened only 2018, right? So now what we have to do, we have to adjust the profit of 2018 to adjust the future profit. Okay. So we have to add the loss. This is an abnormal loss. Okay. So we have to add this loss, abnormal loss due to fire, 9,000 rupees in 2008. Okay. Fine. So we have to do everything opposite whenever there is abnormal loss or abnormal income. And then here we have a third adjustment that the property of a business were not insured and it is now thought advisable to insure the business in future. The premium is estimated at rupees 2,000 per annum. Okay. So now here what they said, they are saying that they are going to insure the business in future. This is an expense, right? Premium is the expense. So insurance premium is an expense. So insurance premium is how much? 2,000 per annum. So this is the future expense. The future expenses reduce the profit of a business, isn't it? Future expenses, they reduce the profit of business in future. Okay. So this insurance premium will be subtracted, and it will be subtracted from all the years. Why all the years? because this is related to, so we have to make it in all the years. We have to make changes in every year because later we are going to pay this insurance premium every year. Okay, so that is why we have to subtract this insurance premium every year. So we have to subtract the future expenses from all the years. Same with the future income also, all the years. But abnormal income and abnormal losses only to the specific years which they occur. But this you have to do with all the years. Okay, so insurance premium will be subtracted by all the years. 2000, right? Fine. And then we have the fourth adjustment. To cover the cost of management, an annual charge of is 10,000 should be made in every year. Okay, so now this is also a cost. It's an expense of management in future, right? It is a future expenses. Normal income, it is a normal income which will arise in future. Okay, so this will also be subtracted. This will also be subtracted. Okay, the cost of management 10,000 will be subtracted from all years. Fine. Okay, simple, right? So this is the future expenses that will be subtracted from all the years. Okay, 10,000, right? So we have to subtract 10,000 from all the years. Okay, so then after subtracting all these, making income and all these, we will get future maintainable profit. Okay, see, 80,000 minus 2,000 will be 78,000, and then minus 10,000 will be 68,000. And in 2017, 90,000 minus 3,000 is 87,000, and 87,000 minus 2,000 is 85,000, and 85,000 minus 10,000 is 75,000. Okay, and then 2018, 70,000 plus 9,000 is 79,000, and minus 2,000 is 77,000, and then minus 10,000 is 67,000. So these all are the future maintainable profit. Simple, right? So this is how you have to calculate the future maintainable profit. Okay, so now let's calculate the goodwill. Okay, so now average profit, this formula is very simple. That is, total profit is divided by number of years. So your total profit is 3 years, 68,000, 75,000 and 67,000. So we have to take all this here and we have to add, and then we have to divide by number of years. How many years? 2016, 2017 and 2018. That is 3 years. So we have to divide with 3 years. So after dividing, we will get 70,000. That is 68,000 plus 75,000 plus 67,000 is 2,10,000 divided by 3 years is 70,000. So this 70,000 is average profit. Okay, average profit, future maintainable profit. It is the future maintainable profit. So now after calculation the average profit, we have to find the goodwill. Goodwill, how we will find the goodwill? Average profit should be multiplied with the number of years purchased. So in the question, we have given that the number of years of purchased is 2 years, estimated at 2 years purchase. So we have to multiply. The average profit into number of years of purchase, that is 2 years. So average profit is 70,000. 70,000 is multiplied with 2 years. So that is 1,40,000 is our goodwill. Clear, right? Okay, right? Fine.